Hey guys, it's Tony. A lot of people have been requesting T-Mobile as a play, but I wanted to come on here and let you guys know exactly why this is a bad decision. T-Mobile is not a good play for the breakout strategy. I mean, maybe a play on momentum, maybe on something else, but as far as playing this for actual the breakout strategy, it's a bad idea, and I'm going to show you guys exactly why it's a bad idea. So essentially, what you have here is you just have a strong trend towards the upside, basically from February 2nd up until now, right? You have this strong uptrend right there, and there's no clear mountain peak. There's no clear mountain peak. It's just a straight shot up to the upside. This is fine if you want to keep playing T-Mobile to the upside, right? I mean, you can probably buy and maybe it might be a good idea just playing on momentum, right? But that's not what we're talking about here. We're talking about why this is a bad idea for a breakout strategy. The reason is we need price to create a clear peak, right? So we have the low right here. It created a peak. Guess what? It came down, retraced, and then it went to the upside, right? Then it went to the upside, straight like this. And guess what? It actually had the peak was broken right here. It was broken right here around this area. This is where it was broken, right? I'll delete that. I'll actually let me add an actual peak. So peak was broken right there. That's where peak was, 135.87. You would have gotten in right here, and you would have generally played this right up to the upside, right? That's exactly what would have happened, and that's how you should have played it. The breakout strategy is not meant to be played on runs like this. I mean, you can use the fibs. Where are you gonna put your fibs? Nowhere. There's no relative high. It's just a continuous move to the upside. But if you actually play it here, you would have your relative high January 11th, and you would have your relative low down here of October 26th, right? You'd set it all the way to the right, set your low. Guess what? Now you have the play that you want to do. That's exactly what should have happened, and if you're playing it any other way, you're going to be wrong, right? You know, you could have been conservative on the forecast too. I mean, usually right now what I'm doing is a 2.5% on the downside of the actual fib. So you can have either taken profit here, but again, you would have probably, if you bought your contracts here, you would have to wait, what, 1, 2, 3, 4, 5, 6, 7, 8, 9. You would have had to buy your contracts out for, what, 2.5 months out to actually get any price movement on the upside. Again, you have to be, I don't want to say conservative, but if you want to play moves like this, you need to see how fast they're actually running. So T-Mobile, guess what? You have to look at the average of these actual jumps. Because if you got in when this actual candle got created towards the upside on the week, which is May 3rd, if you only bought a month out calls, they would have expired right here, and they would have been right under that 2.5%. Again, this is being a little bit on the riskier side, right? What would have been a perfect play, especially for T-Mobile, is maybe doing the forecast on the 5% side. So if you go down 5%, boom. You would have hit your price target when? The very first price target you would have hit a month and a week after. You would have bought here. You would have had 1, 2, 3, 4, 5. You would have hit your price target on week 5, which is about a month and a week after you bought your calls, right there, on May 3rd, right? This would have been the more conservative play, a 5% on the downside. On the upside, you would have basically made, what is this, 135 to 148. So on the upside, you would have made what? Let's say you bought somewhere at like 137, right in the middle, right? On the upside, this would have been a 7% increase in price. So if you bought shares, you would have made around 7%. If you bought calls, you would have probably made a little bit under 100%. You would have probably made somewhere 10% on a move to the upside on any option, on any stock. Tends to usually equal about 100% gains in options. So a 7% increase, you would have maybe made out with somewhere between 50 and 70% gains on that option play if you actually bought a month and a half out, basically, right? And again, you have to base the actual calling on the relative history of how it actually likes to run on the upside, right? But again, T-Mobile would have only been a good play on the shark fin right here from 107 to 136, which is this run up right here. There's no reason for you to set your fibs anywhere on here, right? You can't set your relative high right there and then go down to lows of February 22nd right there, right? You can't do that. There's no clear retracement. There's no clear move towards the downside. You're basically just going up. You're just going up like this, right? Remember, price needs to do that, and then it needs to come back, retrace a little bit, where you actually have a clear mountaintop that got created, and then once price actually moves to the upside, that's when you actually put in your order in. You buy your order in right here. That's when you buy your order in, right? Somewhere around this area. Somewhere around this area right here. That's where you're going to be setting up your buy to purchase. And you're only doing this when it's breaking previous all-time high on a shark fin, or you can call this a mountain peak, whatever. But you can do the same thing for all these, right? Shark fin, ran up, retraced, ran up, retraced. Again, previous high was right here, August 31st, 119. It went up, but guess what happened? It wicked up. It didn't actually close above the previous high. What happened over here? Now your new relative high is from here to here. What happened? Still no close, closed up here, but then it kept running for a couple weeks to the upside. Again, T-Mobile, like I said, it's not a good play to do this right now because there's no relative high. There's a relative low down there, but there's no clear retracement so where you can actually break a relative high, right? It's just a clear upside right now. This would only be like a momentum play or something. This would not be used for the breakout strategy. You would have to have some sort of peak, a retracement, and then you have to beat it out with a weak candle on the bullish side, right? So there's a lot that goes into this strategy. It's not just, hey, it beat previous highs and then it's time to buy. That's not how this works. There's a lot of metrics that go into it. There's a lot of confluences that you have to go through, right? So it's not necessarily just doing that, but it has to be an actual, a company that's been relatively going towards the upside for a while. It has to be a company that's not like a penny stock. It has to be, a company with at least a nice solid market cap, maybe like $1 billion, maybe probably higher than that. T-Mobile, like I said, don't do this play. I don't think it's a good idea. I would never make this play based on the breakout strategy. I mean, even on the monthly, right? On the monthly, you would have been, even here, you can see this clear shark fin right here on the upside, right? But T-Mobile, not a good play. You're not gonna, you might make money. You might make money off this, but it doesn't hit the criteria that it's supposed to for the breakout strategy. And I hope this video explains why. I'll see you guys later.